Joining me right now with more Bullseye Brief, publisher and author Adam Johnson, Vision 4 Fund Vice President Heather Zumarraga, and our own Nicole Petallides down on the floor of the NYSE. I'm going to go to you first, Nicole, as we watch a market that is up now 34 points, climbing higher, we should point out, since that decision was released. As expected?
Yeah, pretty much. I mean, basically, we did see them throw in that word soft about inflation, ex food and energy. So that's an interesting talking point. But big picture here, the Fed funds rate for December is where we're expecting that rate hike. It's interesting how they really didn't give any hints as to whether or not they will do so. They'll stay on this gradual pace. But the other factor here is also who will be the new Fed chair. Trump talked about that and even said you will like this person, or made some sort of insinuation today, which almost led people to believe that it may not be Janet Yellen. But big picture here, we got pretty much what we anticipated. We did move up a little bit here on gold gains and also equity gains, but not too much volatility at the moment. Trish?
All right. Okay, I'm here with Heather. I'm here with Adam. You know, the Fed has been the wind behind this ship's boat or sailboat's boat. I'm getting my metaphors screwed up, but you know what I mean. In other words, there's been a lot of help, right? And now the help is coming away. They're indicating that, yeah, you know, things are going to be moving higher, faster, sooner. I guess my big question is, we look at a market that's 23,421 on the Dow. Wow. Yes. Can it hold? Can it stay? And how critical will tax cuts be to these levels?
Not only, Trish, will this market hold, Trish is going to move higher. We're going to see this market move higher. Tax cuts are part of it, but you know my deal, the two E's of earnings and employment. That's the story. And by the way, Trish, there's another narrative happening here. There's a double-barreled handoff. On the one hand, we're getting a new Fed chair, and the key is not to upset the boat with that baton handoff. And then the other is we're finally getting fiscal policy taking over from monetary policy. We don't need the Fed anymore because American businesses are making money.
Okay, and they're hoping that's the case as well, because they're talking about, Heather, normalization. What is that normalization going to look like in your view as we fast forward over the next couple of years from the Fed standpoint?
I think over the next couple of years, you can expect interest rates to move higher to 3.5%, even 4% perhaps on the 10-year, because as the economy is growing and we eventually will get an uptick in inflation, I understand that right now the outlook for the Fed is for inflation to remain below 2% in the near term, but eventually it will move higher because we have full employment or near full employment, and that will put pressure on wages, thus putting pressure on other prices to rise in the economy outside of food and energy. So you're going to get an uptick in inflation. That will increase interest rates.
Well, do you anticipate, though, that we'll still move higher in this higher interest rate environment, Heather? I mean, can these market levels hold?
I think that will be a headwind for the markets, because right now there's nowhere else to put your money in, although we have good corporate earnings results right now, Trish. I mean, if you have higher interest rates on bonds, for example, then the viewers, the people out there, are going to potentially save more money in bonds instead of putting their money in the stock market, because you're going to get some sort of yield. And you just can't get that right now because interest rates are so low.
Yeah. Well, it's good for retirees. I mean, Nicole Petallides, you know, it's one thing to talk about investors, but let's not forget retirees in all of this that have been living on a fixed income, and they're investors too. And they've been struggling, Nicole, because, you know, you can't, you know, really go down to the local bank and get a CD and get any kind of yield on that. So I've made the point that in some ways my concern has been retirees and conservative investors have been forced into riskier and riskier products like Puerto Rican debt. Right. And there's a certain amount of risk associated with that. As we see this normalization process happen, how does that change the equation for retirees?
Yeah, you're absolutely right. So the savers, to a certain extent, were penalized with such record low rates that we've been seeing. And so as the rates will trend higher, right now we're seeing the 10-year at 2.35%. And as rates trend higher, those people will be rewarded more handsomely. As you noted, they had to move into equities. But ultimately, as things change, and that is your point, and Adam Johnson just talked about, the change in fiscal policy rather than monetary policy brings optimism and an economy economy that will do better ultimately, and that in turn will boost everything higher. I will also couple this with, we'll have monetary policy. Fiscal policy is improving. Ben Bernanke, by the way, used to complain about that all the time, saying that we can't just save the world here with monetary policy. We need the fiscal policy from Washington. We're getting that, rolling back regulation. And the global economy, Trish, is doing better as well, and that too helps things along.
Let me ask you about inflation, though. You know, Adam, you and I have talked a lot about this. I don't get why we're not seeing more inflation in this economy. I mean, why has it been so low for so long? And wages as well. I know we've seen some changes in that, some uptick. But you would think, given everything that the Federal Reserve has done, that there would be more.
You would think. But there are a couple of structural changes that are happening. Number one, you have 10,000 baby boomers retiring every day. I mean, that's just shocking, right? And they're being replaced by cheaper, younger workers who, by the way, aren't necessarily full-time, right? The gig economy. So you don't necessarily have to pay them benefits. You don't have to pay them as much. That's actually deflationary. That's point number one. Point number two, and we could probably go on and find a few, but here are the ones that jump out at me. Point number two is you now have 24/7 conductivity, where any product, any service you could possibly want is available on the internet, and you can see the competition right there. So firms have to compete relentlessly with one another, and so it's harder for them to raise prices.
Yeah, so
it's the Amazon effect, Trish. I mean, prices are low because you can see everything online every day. Every penny matters. It's a race to the bottom in terms of margins for these retail stores.
Tricky times.
Yes.
All right. Adam, Heather, Nicole, thank you very much.